Hello, everyone. We wanted to take a quick moment to thank you all for joining us today. This podcast was recorded and is made available to you by Whitley Penn LLP and WP Wealth LLP solely for informational purposes. The information, views, and opinions expressed in this podcast are general in nature and are not intended to be construed as the provision of financial or investment advice by Whitley Penn or WP Wealth. The information discussed in this podcast is accurate as of the day it was recorded, but may then become outdated over time. Please feel free to contact us if you have any questions, comments, or concerns in regard to the content presented. Thank you again for tuning in, and we hope you enjoy this episode.
Welcome back, everyone. My name is Bree Miller, and I'm joined today by Tom Rein on another episode of WP Talks. Last we met, we were coming off the results of the presidential, Senate, and House elections. We discussed the initial market's reaction to a change in administration and some of President Biden's immediate policy implementation by way of executive orders. We also discussed the recovery we were seeing in the overall economy and markets as we began the rollout of the COVID-19 vaccine. So today, we wanted to get back together as we are experiencing a more robust reopening of the economy across the United States, with more than half of adults having received at least one dose of COVID-19 vaccination. We've also have more history under our belts under a Biden administration and are beginning to receive a clear message around some of his agenda items, such as spending and tax reform. So we wanted to give you all kind of a state of the economy. We are seeing signals of continued economic growth and hope for a fully functioning economy, and would like to share some of the implications and trends as a result. Tom, like I said, we're seeing signs of real economic recovery and growth. As many people have been vaccinated and are able to get out and enjoy life again, businesses are reopening and rehiring has begun. As a result, we've seen a pretty rapid drop in unemployment rate. March's unemployment rate was at 6%, down from 14.7% in April of last year. We heard Chairman Powell anticipates unemployment to move from 6 to 4%, and that he's expecting GDP around 6 to 7, which would be the highest level in 30 years. Sounds more like a boom than a recovery to me. However, with such high hopes for growth, there's concern of inflation. Do you think the fear of hyperinflation is likely? And, if we do experience inflation, what steps can Fed and the Treasury take to help tamper that? And what implications would that have on the economy and the market?
Well, there's a lot in there. And first of all, it's great to be back. There's obviously a lot that's happened since last we visited. And, you did a great job of highlighting some of the changes in the current state of affairs. And, to your question, specifically the first part of that, relative to inflation. We hear every day that seems to be the overriding concern that most analysts talk about is, with all the liquidity and, extremely low interest rates, is there the opportunity to go back to what we saw in the late 80s when we were in a hyperinflation environment, and obviously the damage that does to an economy. But I think it's important to kind of peel that back a bit. Certainly we see inflation today. We know about home prices and car prices. There's not a purchase that a consumer makes today that they're not seeing inflation in. But I think it's important maybe to differentiate what we're seeing in the short term versus what may be a longer trend. To me, when I think about inflation, I go back to the definitional inflation of too much money chasing too few goods. And so when there's excess demand and limited supply, obviously prices increase. A perfect example is housing today. There's very little inventory, and so we're seeing excessive price increase. And I think in the short term, we're definitely seeing that, but I'm not sure that it's not more of a matter of a result of the COVID lockdown economy where production and manufacturing was impaired either because facilities were shut down or parts of the world where we're getting goods from are still in a lockdown mode. So I think we are having constricted supply, and there's no doubt there's a tremendous amount of liquidity, either through the economy reopening or through federal spending programs, that is creating the inflation. But I'll be curious when the world opens up in a full way, whether manufacturing activity can reestablish inventory levels and things normalize, or whether this is more of a permanent issue. I find it hard to believe that in the current state of affairs, that the majority of, let's just focus on America, the United States versus the rest of the world. We hear discussions about the haves and the have-nots, and obviously the population is made up majority of have-nots that still are living paycheck to paycheck and don't really have excess income at the end of the month. So I find it hard to believe that's going to change materially in the short term, where all of a sudden the majority of the purchasing class now has excess income in their pockets to continue a sustainable excess demand for goods and services, which would cause traditional inflation. So I guess I'm betting more that it's an effect of the COVID shutdown, and that it'll be transitionary to get stockpiles back to a level where it's meeting demand and prices stabilize over the long term. So we'll see. But the second part of that is, so if it is, to your point, if it is more systematic, that it's really the inflation is more of a problem because we're growing, as you mentioned, maybe at 6 to 8% GDP growth, and unemployment falls to pre-COVID levels. What can the Fed do to alleviate that? And I think it's really a matter of switching off of an accommodative Fed policy, i.e. low interest rates, purchasing bonds, creating liquidity, to more of a contractionary situation where they're either stop buying bonds or actually start canceling some of the Fed balance sheet through Fed moves, and also increasing interest rates, which would be contractionary to the economy, which are traditional moves that the Fed would take to slow down economic growth. So, we've been told by them that they're not even going to consider that until 2022, that they're willing to let inflation run up, because I think they also believe it's transitionary, that longer term the economy is probably not going to be at a level that is going to create sustainable inflation. But we shall see. But I think we're pretty safe for the rest of this year, at least, before we have to worry about that.
So you mentioned the Fed's ability to adjust interest rates. While it might be later next year, but that is a possibility. So how could we anticipate an increase in interest rates affecting consumers and the companies that they're investing in?
Yeah, so I think obviously it would be very problematic. I think higher rates would definitely be an issue for economic expansion and growth and stock prices. You got to think about the level of debt that, as an economy, that we have taken on, not just in the last year or two with COVID, but over the last 10 or 15 years through some of the expansion of government spending as a result resulting from the 08-09 financial crisis, and then really ever since then. We're looking at close to $30 trillion of debt, not even accounting for some of the off-balance sheet debt that various government agencies carry, whether it's Social Security or Medicare or the like. And you multiply that downstream, so you think about the federal government debt load, and then recognize the amount of debt issuance that states, local municipalities, down to household level, the size of mortgages that are being taken, and then businesses are very highly levered, and largely because interest rates were so low, they found it to be a very attractive way of financing expansion and acquisition of their businesses. So when you consider an increase in interest rates and magnify that at the level of debt that the economic system takes on, it'll be a huge drag from available capital for more expansionary purposes. And so I think it will certainly impact consumers as their borrowing costs increase, whether it's loans on cars or homes or credit cards. Certainly businesses will be impacted. It'll have an erosion on earnings because their balance sheets have taken on so much debt over the years. It will affect earnings per share. And from the government levels, both state, local, and federal, it will take a drag off of tax collections as far as their ability to invest in more expansionary ways of growth, and whether it's federal level or state level, and it'll be a drag on that. So I think it will certainly have impacts on reducing the amount of economic growth that we could have.
So you talked about the level of debt that consumers and companies are taking on as a result of low interest rates. It's interesting, margin debt has reached the highest point in 2 years as investors have borrowed a record $722.1 billion against their investment portfolios through November of last year. We saw Robinhood, a popular retail investor platform and most recently known for the controversy with GameStop, has lowered their margin rates from 5 to 2.5% at the end of last year. And just last month, we heard about the massive losses generated by Archegos, who went bust after borrowing billions to speculate on stocks such as Viacom CBS. So, we know that the low interest rates has encouraged some speculation. How do you think, that's generally affected appetite for risk?
Yeah, that's a great question. I think Robinhood is a perfect example. There's probably a big percentage of the investor population that came into the market after the financial crisis. So, we hit a low point in, I believe it was April of 2009 from the financial crisis. And then for the last 12, 13 years, we had nothing but steady upward trends of stock returns. And so if I'm an entrant into investing within that time period, all I've experienced is positive returns. And so if given that, and I've been conditioned that the markets are going to continue to go higher because of spending and growing economies, and I have the access to take some debt, margin debt or other source of debt at extremely low interest rates, and have the belief that investment returns will continue at a robust manner for the foreseeable future, I think it encourages speculation and risk. So much of investment in crypto and in a lot of these SPACs and a lot of the other investment themes that we're seeing out there today are being done with leverage, margin debt, or other types of debt. And I think it truly encourages that speculation and risk taking. That works until it doesn't. And as we all know, markets don't go up forever without adjustment. And so the question is, with all that speculation, with the increase of leverage, are we going to experience a really ugly time in the market as that unwinds and those margin calls? We saw a little bit of that when the private family office went under because of their speculative option trading. It really did have an impact, at least for a short period of time, and that was isolated. But if you see that on a more widespread, systematic basis, I think the markets could be in for a pretty volatile period. So that leverage is not reducing. If anything, it's increasing. And so that's something we certainly need to keep our eye on and understand. But I think it does certainly dislocate capital flows and encourages excess risk-taking along the way.
Most of what we've just spoken about sounds like trends and fears that may cause an investor to want to pull back risk or proceed with caution. However, last time we met, we spoke and discussed about the positive impact that continued spending and some of the agendas under the Biden administration for spending was going to have on the market. So, we just saw the approval of the third stimulus package. We're still working through spending that. And then next up, we know, is an estimated $2 trillion infrastructure plan. So we know that spending will continue at least for the next year. How do you see this impacting ongoing growth in the market and some of the trends that we're seeing as a result of that?
Yeah, I think certainly it will be favorable to stock prices in the short, at least in the short term. When all that liquidity gets spent in a marketplace, and you put the multiplier effect on money, and as it changes hands and it changes hands, obviously it's going to create economic growth. It's whether that economic growth is sustained or whether it's a one-time deal, that's yet to be seen, and that depends on the type of programs and projects that the infrastructure plan is earmarked to benefit. I think that's in the short term. Unless the economy can pick up its steam on its own, independent of that stimulus or that support, it could be short-lived. But if in fact it's spent wisely and it's invested in ways that creates multiples of economic growth, then I think it could be more long-lasting. The concern that I have is that given the level of spending, that maybe at some point we compromise the value of the dollar, that maybe the dollar loses its value worldwide from a global perspective, and maybe the world potentially loses confidence in the dollar if it becomes too commoditized and worth less. So you think about the value of a dollar today versus a year ago, and consider, the trillions of printed money, obviously unpaid for spending that has come out of Washington and really pushed out from the Federal Reserve. In theory, obviously a dollar today has to be worth less than it was a year ago before we put trillions of printed dollars into the marketplace. My hope is that it doesn't weaken the perceived value of the dollar around the world, and allow for alternative currencies, whether it's crypto, and it's a whole different podcast discussion probably, but or other baskets of currencies that the world may look to as a more stable force. I think if that happened long term, I think that would be very problematic for our country, given the level of debt that's denominated in dollars, and how we're perceived as the economic kind of stable force around the world.
To that point, we last touched on this in our last episode, but we know that there must be some kind of offsetting revenue for this level of spending. We've received more details around tax reform, with the first focus being on corporate taxes. Will you share some of the details on those changes that are being talked about, and where do you think tax reform goes beyond adjustments to corporate rates?
Yeah, that's a really important discussion, and which is just taking shape right now. For the first time, they're actually, Congress is actually trying to link some of the spending with some revenue raise. So maybe the recognition that the concept of modern monetary theory, where you can just print money to accomplish stated goals, has hit a roadblock where they're actually talking about needing to pay for. And so, as you've indicated, this first infrastructure package that's still being negotiated, they've kind of earmarked or tagged corporate taxes as the pay for on that. And the Biden administration has been very clear that their goal is not to impact certain taxpayers. They use a threshold of $400,000 of earnings and below. But the reality is, everybody is impacted by corporate taxes. So forget about individual income taxes and payroll taxes and estate tax. That's coming down the road. But as you affect income taxes of corporations, as a corporation, they have the ability, to the extent they can, and especially if we're in an inflationary environment, to pass those increased costs, i.e. taxes, in the prices of goods and services. So that affects every income level, whether you're at the lowest level or the highest level. If you're buying things and corporations are increasing the cost of that to the consumer, everybody's paying for that. So that just falls on its face that only certain taxpayers will be impacted. Everybody will be impacted. So that's a drag, on the economy, to the extent I have less money to spend because everything I spend money on costs more. It's a drag on economic growth. But more importantly, what we don't want to do is put the United States at a disadvantage globally for business. So if because of taxes, it costs more to produce a widget or provide a level of service, and the consumer can find that same alternative through another manufacturer in a different country at a lower cost because taxes are lower, then prudent business would indicate that you supply those goods and services at a lower cost, at a lower price. Consumer wants that. They have more income to spend on other goods and services, but obviously that affects employment. It affects our local economy. So first and foremost, we have to be really thoughtful about working or tinkering with taxes. First on the platter, obviously being corporate taxes. What we saw under the Trump administration is by lowering corporate taxes, we created tremendous economic growth over the last administration as compared to the prior many years, and unemployment was at a historic low levels. You could infer that was a direct correlation between a more positive business environment with tax policy and regulations that transcended into stronger economic growth and lower employment, raising wages. So I hope that increases in corporate tax rates don't have the reverse effect. And my fear is that they very well could. The next part of it, as I understand, the administration is soon to come out with part 2, which may be another trillion or a trillion plus of programs, and they really haven't developed what those will be yet. But as we understand, probably link the funding of those with individual tax changes. And again, that's where specifically the Biden administration is talking about affecting only certain levels of taxpayers. So under the corporate tax increase, everybody pays for it. Under a targeted individual tax increase, maybe a segment of the population. The risk there is that you make it unattractive for those that have capital that make the investments in the economy to be willing to take a risk for a watered down return. So a risk return basis, if it gets too low because of tax erosion from your expected return, it may impede an appetite for investing in expansionary type projects. And so taxes generally are misallocation of capital. It's government taking more money from the investment community, which potentially could be invested in more robust, economically stimulative projects, and captured by governments and spent in a less effective, less economically stimulative way. That's generally not a great recipe for economic growth. People spin it, people have opinions about it, but bottom line, if capital markets can spend money in the most effective uses for stimulus and growth, it's usually more effective than when government does it. So again, we're still early in administration. It's becoming a little clearer on what their position and posture is in both spending and as we're starting to understand taxes. So I guess stay tuned, and we'll see as this becomes more of a reality what the implications are for economic growth and for appetite to make investment going forward.
Really great information. Thanks for that. So, all very important items to think about and evaluate as investors in the market. Like you said, these big policies and agenda items are, just in their beginning stages. As financial advisors, it's our job to observe these trends and react proactively in incorporating this information in our clients' financial and investment decisions. So maybe on our next episode, we should look to get back together to discuss some of the planning ideas that could come to light as a result of some of the topics that we discussed today. I think that would be useful to our listeners.
Yeah, I agree. I think with every change, there's other opportunities. We saw that last year with the CARES Act and Secure Act. As legislatures reacted to the current environment and changed rules, it provided some great planning opportunities that we were able to implement on behalf of our clients to put them in a better financial position or tax position or just a more secure financial state, if you will. And so certainly with change, it will close some opportunities, but maybe open up some others. So look forward as we get more detail on that to get back together and share some of our thoughts on how investors and and consumers may take advantage of the changing environment to put themselves in a better position.
Yep, that's a great tease for the next series, and hope you guys will continue to look for our newest releases. Thanks so much for joining us today. Please follow along and check out our websites at WPWealth.com and follow along with us on LinkedIn. Thanks again.